Hey everyone, welcome to the show. Today's episode, Credit to Cash, the complete guide to liquidating your credit cards strategically. Turn your credit limit into real liquidity without destroying your credit score or paying crippling fees. This one's made for entrepreneurs, side hustlers, and financially savvy individuals who want to leverage existing credit lines to fund opportunities, cover cash flow gaps, or build wealth without taking on predatory loans, and by the end you'll have real, practical skills you can use right away.
I'm really excited about this one. Here's what we're covering together today. Module 1. Understanding Credit Liquidity, the Foundation. Module 2. The Core Liquidation Methods. Practical Techniques that Work. Module 3. Protecting your credit score during liquidation. Module 4. Deploying liquidated credit for maximum return. Grab a coffee, get comfortable, and let's dive in.
Alright, let's get into it. That brings us to Module 1. Module 1. Understanding Credit Liquidity, the Foundation. Explain what credit liquidation is, why it works, and identify which credit products are best suited for conversion to cash.
In this part of the show, we'll talk through what credit liquidation actually means and what it doesn't, the credit products worth liquidating, and the ones to avoid, the legal and ethical framework, staying on the right side of the line.
Credit liquidation refers to the strategic process of converting your available credit into spendable cash or cash-equivalent purchasing power. This is not the same as simply maxing out a card. It involves intentional methods that minimize costs and preserve your credit profile. Banks extend credit expecting you to use it for purchases, but sophisticated users understand that credit itself is a form of capital that can be deployed in multiple ways. The difference between a financially struggling person and a wealthy one often comes down to their ability to mobilize capital quickly, and credit is one of the most accessible capital sources available to everyday people. This lesson sets the mental framework. You are not borrowing recklessly, you are managing a financial instrument.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: credit is capital. Treating it as a strategic financial instrument rather than a spending tool is the first mindset shift required. Okay, quick pop quiz for everyone listening. What is the primary difference between recklessly maxing out a credit card and strategically liquidating credit?
Not all credit products are created equal when it comes to liquidation potential. Cards with 0% APR promotional periods, high credit limits, and low or waivable cash advance fees are your best candidates. Personal lines of credit and business credit cards often offer better terms for cash access than standard consumer cards. Retail store cards and APR cards should generally be avoided for liquidation because the cost of capital becomes prohibitive almost immediately. Understanding the annual percentage rate, cash advance APR, transaction fees, and grace period structures of each card in your wallet is non-negotiable before you attempt any liquidation strategy.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: always calculate your true cost of capital before liquidating any credit product. Not all available credit is worth converting. Okay, quick pop quiz for everyone listening. Which feature of a credit card most reduces the cost of liquidating it into cash?
Credit liquidation strategies exist in a wide spectrum. Some are standard financial practices, others cross into terms of service violations or outright fraud. Balance transfers, for example, are an officially supported bank product. Using a card to purchase money orders for resale is a gray area many issuers prohibit. Manufactured spending through gift card arbitrage has been cracked down on heavily by banks and rewards programs. The safest and most sustainable strategies are those that align with the issuer's intended use cases while still serving your financial goals. This lesson teaches you to evaluate every technique through the lens of sustainability, legality, and long-term relationship preservation with your credit issuers.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: sustainable credit strategies never burn bridges with issuers, always operate within a framework you can repeat without fear. Okay, quick pop quiz for everyone listening. Why is it important to review a credit card's terms of service before executing a liquidation strategy?
Okay, moving right along. That brings us to Module 2. Module 2. The Core Liquidation Methods. Practical techniques that work. Execute at least 3 specific, actionable credit liquidation strategies and understand the cost-benefit profile of each.
In this part of the show, we'll talk through balance transfers and convenience checks, the lowest cost path, cash advance optimization, when and how to use it without getting destroyed. Peer-to-peer payment platforms and spending proxies, the modern method.
Balance transfer checks and convenience checks issued by credit card companies allow you to write a check directly to yourself, depositing credit line funds into your bank account at a fraction of the cost of a cash advance. Many issuers offer promotional balance transfer rates of 0% for 12 to 21 months with a one-time fee of 3 to 5%, making this one of the cheapest ways to access credit as cash. The key is timing your application for a new card specifically during a strong promotional offer, then depositing the transfer check before the promotional window opens. Always confirm with the issuer that the check can be made payable to yourself and deposited. Most allow this, but terms vary. A $10,000 balance transfer at a 3% fee gives you $9,700 in usable cash at an effective annual rate far below most personal loans.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Convenience checks during 0% promotional periods are the single cheapest method for converting credit to cash with minimal cost. Okay, quick pop quiz for everyone listening. If a credit card offers a 0% APR balance transfer for 15 months with a 3% fee, what is the total cost to access $5,000 in cash?
Cash advances have a terrible reputation because most people use them without understanding the full fee structure, and they are right to be cautious. Cash advances typically carry a transaction fee of 3 to 5% and a separate, higher APR that begins accruing immediately with no grace period. However, in specific scenarios, such as when you have a card with a low flat cash advance fee and you plan to repay within days, they can serve as a short-term bridge instrument. Some credit unions and smaller banks offer credit cards with no cash advance fee and identical APR for purchases and advances, making them far more useful for this purpose. The optimization strategy is to identify those specific products, keep them active, and deploy them only for short-duration needs where the math clearly works in your favor.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Cash advances are a last resort tool for people who have done the math. Never use one without calculating the total dollar cost first. Okay, quick pop quiz for everyone listening. Why do cash advances on most credit cards cost more than balance transfers even if the listed APRs seem similar?
Modern payment platforms like PayPal, Venmo Business, and certain fintech tools allow users to send credit card payments that get deposited as cash to a linked bank account, sometimes for a fee of around 3%. The strategy involves using your credit card to fund a PayPal account and then withdrawing those funds to your bank, effectively converting credit to cash with a predictable, manageable fee. Some entrepreneurs use this method to pay themselves for services rendered through their own business entity, creating a legitimate paper trail and a genuine reason for the transaction. It is critical to understand that platforms are increasingly flagging circular transactions, sending money to yourself through shell accounts, so any use of these platforms must correspond to real economic activity. Business credit cards used to pay legitimate vendor invoices through platforms like Melio or Bill.com represent another sophisticated avenue that keeps everything above board.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Digital payment platforms are powerful tools for credit liquidity only when the underlying transactions reflect real economic activity. Okay, quick pop quiz for everyone listening. What risk do peer-to-peer platforms specifically watch for that could get your account flagged or closed?
Okay, moving right along. That brings us to Module 3. Module 3, protecting your credit score during liquidation. Execute liquidation strategies while keeping your credit utilization, payment history, and overall credit profile intact or improved.
In this part of the show, we'll talk through understanding credit utilization and how liquidation impacts it, the payment discipline system, never miss, never minimum, credit limit management, getting more to risk less.
Credit utilization, the ratio of your outstanding balance to your total available credit, is the second most influential factor in your FICO score, accounting for roughly 30% of the calculation. Liquidating a significant portion of a credit card's limit can spike utilization and temporarily drop your score by 20 to 50 points or more. The strategic countermove is to distribute the liquidation across multiple cards rather than concentrating it on one, keeping individual card utilization below 30% and total utilization below 10% whenever possible. Timing matters enormously. If you know your statement closing date, you can pay down balances before the statement cuts, so the reported balance to the bureaus reflects lower utilization. Score recovery after high utilization is fast, often within 1 to 2 billing cycles once balances are reduced.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: always calculate the utilization impact before liquidating. Spreading across multiple cards and timing payments around statement dates minimizes score damage. Okay, quick pop quiz for everyone listening. If you have a $10,000 credit limit on one card and liquidate $4,000 from it, what is your utilization on that card and how does it affect your score?
Payment history is the single largest factor in your credit score at 35%, and any liquidation strategy that causes you to miss a payment is self-defeating. Build a payment discipline system before you begin liquidating. Set up automatic minimum payments on every card as a safety net, then layer in manual full or larger payments in the weeks before the due date. When liquidating for business or investment purposes, the cash generated should be deployed with a clear repayment timeline in mind. Treat the credit card like a short-term business loan with a hard due date. Create a liquidation ledger, a simple spreadsheet tracking the amount borrowed, the date borrowed, the due date, the fee paid, and the repayment plan. This discipline separates people who use credit as a wealth tool from those who use it as a financial trap.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: a single missed payment can undo months of credit building. Automate your safety net before executing any liquidation strategy. Okay, quick pop quiz for everyone listening. Why is setting up automatic minimum payments important even if you plan to pay your full balance manually?
One of the most powerful ways to protect your score during liquidation is to increase your total available credit before you begin, so that the same dollar amount borrowed represents a smaller percentage of your total limit. Requesting credit limit increases on existing cards, especially those where you have a strong on-time payment history of 6 or more months, is free, often results in only a soft inquiry, and can significantly expand your liquidation capacity. Opening a new card with a high limit also adds available credit, though it temporarily lowers your average account age. Business credit cards are particularly valuable because many of them do not report to personal credit bureaus at all, meaning you can maintain high balances on business cards without impacting your personal utilization ratio. Building relationships with issuers by using cards regularly and paying on time consistently is the fastest organic path to higher limits.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: increase your total credit availability before liquidating so the borrowed amount represents a smaller, less damaging percentage of your total credit. Okay, quick pop quiz for everyone listening. How does opening a new credit card with a $15,000 limit help protect your score when you liquidate $5,000 from an existing card?
Okay, moving right along. That brings us to Module 4. Module 4, Deploying Liquidated Credit for Maximum Return. Identify high ROI uses for liquidated credit and build a repayment strategy that ensures the borrowed capital generates more value than it costs.
In this part of the show, we'll talk through the ROI test, how to know if liquidating is worth it, float strategy, using the grace period as a zero-cost loan, building a revolving credit war chest, the long-term wealth strategy.
Every credit liquidation decision should pass a simple ROI test. Will the cash generated produce a return that exceeds the total cost of borrowing? If you liquidate $5,000 at a 3% balance transfer fee, your cost is $150. If that $5,000 is used to purchase inventory that generates $1,200 in profit within 60 days, the strategy was a massive success. Conversely, using liquidated credit to cover personal expenses that generate no return is a path to debt accumulation regardless of how sophisticated the liquidation method was. The most common high ROI uses of liquidated credit include funding inventory for product businesses, covering operational gaps in cash flow positive businesses, real estate earnest money or option fees, and short-term arbitrage opportunities with a defined exit timeline. Always model the worst case. If the investment fails, can you still service the debt?
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: never deploy liquidated credit without running a clear ROI calculation. Borrowed capital must produce more value than it costs. Okay, quick pop quiz for everyone listening. You liquidate $8,000 at a 4% fee to invest in a business opportunity. What minimum return must the investment generate to break even on the cost of capital?
The grace period on a standard purchase credit card, typically 21 to 25 days after the statement closing date, represents a genuine interest-free loan period that sophisticated users exploit strategically. By making purchases on the first day of a billing cycle and paying the full balance on the due date, you can access up to 55 days of float on some cards at zero cost. When combined with a high-yield savings account or short-term investment, this float becomes a legitimate arbitrage opportunity. The cash sits in a 4 to 5% APY savings account while your purchases are covered by interest-free credit. For business owners, this means paying suppliers with a credit card on day one of the cycle and collecting receivables before the due date, effectively running the business on the bank's money. The discipline required is absolute. Float arbitrage only works if you never carry a balance and never miss a payment.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. The grace period is a zero-cost loan available every single month. Use it to float cash in interest-bearing accounts or cover business operations. Okay, quick pop quiz for everyone listening. How many total interest-free days can you potentially access if your billing cycle closes on the 1st and your payment is due on the 25th of the following month?
The ultimate goal of mastering credit liquidation is not a single transaction, but the creation of a permanent, revolving credit war chest, a portfolio of credit lines that you can access, deploy, repay, and redeploy repeatedly as opportunities arise. This requires actively managing your credit profile to maintain high scores, cultivating relationships with multiple issuers, and building a track record of responsible, high-volume credit use. Wealthy entrepreneurs and real estate investors routinely maintain $100,000 to $500,000 in available personal and business credit lines specifically for this purpose. Building your war chest starts with one well-managed card, expands with consistent on-time payments and strategic credit limit increase requests, and eventually becomes a self-reinforcing system where your credit history makes issuers compete to offer you better terms. The person who builds this system over 3 to 5 years will have access to capital that most people only dream about, at costs that rival bank financing.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Credit mastery is a long game. Build your revolving credit portfolio with the same discipline you would use to build an investment portfolio. Okay, quick pop quiz for everyone listening. What 3 habits, practiced consistently over time, most directly contribute to building a large, accessible credit war chest?
And that's a wrap on Credit to Cash, the complete guide to liquidating your credit cards strategically. You now have everything you need to put this into practice.
Thanks for hanging out with us today. Take what you learned, start applying it right away, and keep going. We'll see you in the next episode. Good luck out there.